Introduction to structure notes. Structure notes are investment vehicles made up of different building blocks, a bond or deposit that aims to provide the capital repayment feature, and financial instruments linked to the underlying asset, which often is an option or derivative strategy that provides the return feature of the investment. The two components combined create a unique investment, and the level of risk and return can be customized to meet the needs of the target investor. Both the return and capital repayment depends on the performance of an underlying asset such as equities, indices, funds, interest rates, currencies, commodities, and many other asset classes. Compared to other investments, structure notes offer defined returns that are contractually binding, and the possible return and capital repayment scenarios are communicated to investors before the investment is made. Since most of the features are defined at the outset, they can easily be divided into different product categories, making it easier for investors to find the right investments for them. They are bought by institutions, high net worth individuals, and retail clients. Let us start with capital protected notes. When investors seek to get back what they invested at the end of a period of time, plus a return in excess of deposit rates, they use capital protected notes. Their return is similar to bonds, and they are mainly used to provide participation in different asset classes while protecting the capital when the market drops. Now, let's look at yield enhancement notes. These notes may provide investors the opportunity to generate higher yields and are suitable for investors willing to risk some or all of their investment to obtain this income. An investment in this category usually involves less risk than a direct investment in its underlying asset, since they often have some level of predefined protection against market falls. However, investors may potentially lose some or all of their investment if the underlying asset falls below this level of protection. Leverage notes. Leverage notes are used when investors are looking to take a directional position on an underlying asset while only investing a fraction of the underlying price. Investors therefore take advantage of leverage amplifying underlying movements. They are widely used to change the risk profile of investment portfolios, but are also used to hedge against negative market scenarios. What are the risks and benefits that you should be aware of before investing in a structure note? Benefits of a structure notes. Their flexibility means that they can give investors exposure to different asset classes, and they can be designed with a different level of protection, and the expected returns are clearly defined at the outset. Risk of structure notes. Counterparty is the risk of a client losing money when there is a failure of the bank backing the note. Both returns and capital repayment may be exposed to downside market risk. You should be willing to hold your structure notes to maturity, since there may not always be a liquid secondary market. This is not a complete list of risks, and you should always read the documentation of the product before investing and speak to your financial advisor before proceeding with an investment. Thanks for watching this video.